Hello and good morning. You're tuned in to the Moneycontrol live stream and you're watching Opening Bell with me, Santosh Nair. Well, in the spotlight this morning, we have the big debate on whether trading hours on Indian stock exchanges should be extended. Now, the whole debate has been once again brought center stage after the National Stock Exchange MD and CEO Ashish Chauhan yesterday said on the sidelines of a press conference that maybe it's time India had longer trading hours. Now, there is a logic for having longer trading hours, the most important being that already globally you have exchanges in the US and also the Singapore exchange being open to about 16 to 18 hours a day. That being the case, there is no reason why Indian markets also, Indian equity markets can be open for that quantum of time during the day. Now, the other reason why probably having longer trading hours makes sense is that India has been losing business in trading in Nifty to Singapore, because Singapore is open even after Indian markets have shut. A lot of institutional investors, particularly foreign institutional investors who want to take exposure to India, they trade in Nifty futures on the Singapore Stock Exchange. So that is causing this is something that has been bothering policymakers for a long time now, that the loss of futures volumes to Singapore Stock Exchange. Now, can that be resolved? That's the big question here. But at the same time, some context here. Trading hours were extended back in 2010. Now, at that point of time, the exchanges were also keen in favor of extending trading timings, because that also means higher turnover. But that really has not turned out to be the case. Of course, trader turnover on the exchanges have risen over time, but at that point in time, the thought that if you keep trading hours, the stock market open for longer, you will have more trading turnover, that exactly didn't play out. But now the situation has once again changed. When you have other global exchanges open for a longer period of time, then perhaps it does make sense to have Indian stock exchanges also open for a longer duration of time. Right now, the commodity markets are already open for about 15 hours every day. Now, this move is also likely to draw protest from some of the smaller broking houses. That's because while the larger broking houses may be able to run their operation in shifts, the same may not be the case with the smaller broking houses and smaller players, because that will mean that the operating costs will go up. They will need to have that kind of manpower to have their operations running through the day. So clearly this is again going to lead to a lot of debate whether it is indeed worth to keep stock exchanges open for a longer duration during the day. Well, that said, let's have a look at the market setup. Now, the SGX Nifty futures are indicating a muted start for the Indian market. Now, yesterday we saw a fairly good rebound, both Sensex and Nifty closing on a strong note. The recovery in small and mid cap stocks was a little slower though, but at the same time you're seeing the overall sentiment slightly negative this morning. But let's see how the markets play out after opening at this point in time. Meanwhile, taking cues from the global markets, the equity markets in US ended lower for the fourth consecutive trading session on Monday. There's clearly concerns about an impending recession. They seem to be gaining ground. European markets, however, ended on a higher note. Back home, foreign institutional investors were net sellers on Monday. We saw some fairly good amount of buying from domestic institutional investors, though. We'll have to see whether that trend persists today. Now, the one thing positive at this point in time for the bulls is that the India VIX has been steady in a range of between 12 to 20. Now, typically when the VIX moves in that range, you have the markets trending higher. A lower VIX reading always means that market expectations of volatility in the days ahead, that appears to be a little lower. So, typically Indian markets have always done better whenever the VIX has traded steady in the 12 to 20 range, which it has been doing for quite some time now, despite the occasional sharp swings. And a look at the FNO cues this morning, we are seeing long build up in futures of Britannia. We are also seeing long build up in the futures of Muthoot Finance and Escorts. Escorts has been quite an interesting stock, fairly volatile. After a very disappointing set of first quarter numbers, it did do slightly better in the second quarter, but on the whole, after the change in management, the stock has been pretty much moving in a narrow range. The management, however, feels that the outlook for tractor sales remains pretty strong. We are seeing short covering in futures of India Mart, Adani Ports and Canfin Homes, and we are also seeing some kind of short build up in futures of Chambal Fertilizers, Coromandel International. So, the sentiment for fertilizer stocks in general seems to have changed for the worse over the last few trading sessions. They have been underperforming. Besides that, we are also seeing some build up of short positions in futures of Alchem. And with that, let's move on to the newsmakers on our list this morning. NBCC is the first of the newsmaker. Now, the company has bagged construction orders worth 69.3 crore from the Odisha Power Transmission Corporation. This again a stock which has been fairly volatile over the last month or so. The stock has done pretty well, but however, the controversies regarding some of its projects at this point in time, that is leading investors to take a slightly cautious view on NBCC. HDFC is the other newsmaker this morning. The company has hiked its prime lending rates by 35 basis points for both its new and existing customers. Now, typically, whenever rates are hiked, it often adds to the bottom line of mortgage companies. That's because while they are able to pass on higher costs to their customers very quickly, the cost of their funds, that is increase in deposit rate, that usually happens with a lag. So, this clearly benefits banks whose big chunk of the portfolio is a good chunk of the loan portfolio is geared towards floating loan rates. Let's take a look at the hot brokerage bets this morning. Nomura has rated JSW Steel reduce. The target price for Nomura is 570 rupees. Now, one of the main reasons why Nomura has a bearish view on JSW Steel is flagged the fact that Indian hot rolled coil prices have declined in November and are now at a major discount to Chinese imports. However, it also has a few positive things to say about JSW Steel. Now, the company had conducted it had taken some analysts to visit its Dolvi plant, and most analysts in fact have come out feeling positive about the whole thing. Now, according to Nomura, Dolvi operations have demonstrated significant efficiency of operations. Besides that, the operational improvements at Dolvi will also lead to additional cost savings. And in other newsmakers, Dabur India promoters are likely to sell about 800 crore worth of shares via block deal. The block deal is likely to be at a 4% discount to the current market price. This is according to sources telling CNBC Awaaz. Now, in IRCTC, LIC has bought an additional 2.3% stake via open market transactions, and with that, LIC has increased its holding to about 7.3% from 5% earlier. Now, in the case of IRCTC, the stock had been under pressure of late after the government announced that it was going ahead with its offer for sale issue. The offer for sale issue saw a good response, but at the same time there are concerns about IRCTC whether it will the main pillar of growth, which is internet ticketing. Now, that's seen a good growth over the last 1 year, but now at this point analysts are waiting to see if the company will be able to maintain that same kind of momentum in the years ahead, in the quarters ahead. And while outlook on its catering business is fairly strong, the big margins actually they come from the internet ticketing business, where the margins are as high as about 80%. So, that is something that the market is keeping an eye out for. So, LIC's decision to load up on shares of IRCTC clearly is signaling the return of institutional investors back to the counter. Now, institutional investors' interest in the stock had taken a sharp dip since September of 2021, and since then the stock has also been struggling for a while. And let's now have a quick look at the stock takes this morning. Colgate-Palmolive is the first stock on our watch list. The stock is risen by about 3% over the last couple of trading sessions. Now, According to dealers tracking the counter, the recovery has more to do with short covering of positions. The company had held a meeting with analysts last week. Now, at the meeting, the company had outlined its growth strategy. It did not give any clear guidance in terms of the kind of growth that it was looking for, except that it has said that it would be looking to give preference to volume growth over margins in the near term, and at the same time it also said that it was trying to sell more of its premium offerings. According to Citi, brokerage house Citi, that is quite a tall order, trying to increase your volumes as well as sell more of your premium products, and that's what the company has, that's the target that the company has set out for itself. So immediately after the analyst meet, the stock fell by close to about 4%. Now it has managed to recover some of those losses over the last couple of trading sessions. That's largely because of short covering. Now the key strength for Colgate is that it's got strong market penetration, close to about 88%, which means that nearly 9 in 10 households use Colgate. Now the urban part of the portfolio, on the urban side the market penetration is quite strong, but the rural side is probably where the company sees a lot of opportunity, considering that penetration is quite low at this point in time. At this moment, the company earns close to about the amount of revenues that the company earns from premium products is in the early double digits. Now the company is planning to increase that by having a better connect with dentists and also increasing innovation in oral care products. The company has also set up a B2B portal for dentists, specifically targeted at dentists, and it's trying to it's in the beta phase right now, and it will go on stream shortly. Next stock on our watch list is Heritage Food. The stock has been steadily inching up. It's risen close to at a 6-month high. Now the top line growth during the first quarter was pretty strong. However, the margins were under pressure, mainly due to higher milk prices. The company was not really able to increase milk prices during the first half. Now the company's strategy, according to Moneycontrol Pro, is to increase the share of its value added products. Value added products currently account for close to about 30% of its sales. Now the company is planning to increase that to about 40% in the coming quarters, and also an increase in the per capita income in households that is likely to see a shift from the unorganized to the organized sector. This is again one area which this again one development that could benefit Heritage Foods. But there are also some of the risks that have been flagged by the Moneycontrol team, and according to the Moneycontrol Pro analysts, the inability to raise milk prices, that's a big risk, and also at the same time the inability to procure more milk because of higher competition. And lastly, there is also the factor of political connections. The company is owned by former Andhra Pradesh Chief Minister Chandrababu Naidu, so that's also one of the negative one has to keep in mind for the stock. Well, with that, the market has opened, it's opened on a negative note at this point in time. The Sensex is down by close to about 269 points. The Nifty Midcap is also down by about 0.2%, Nifty Bank down by 0.3%. Market breadth is steady at this point. A little over 1100 stocks are up on the NSE and about 600 stocks down. And among individual stocks, we are seeing some bit of selling pressure in Bajaj Hindustan, Sri Renuka. Sugar stocks had a good run in the last couple of trading sessions, but today there seems to be some bit of profit booking in early trade. The Nifty down by close to 93 points at this point. This was very much in line with what the SGX futures had indicated. Moving over to the last stock on our watch list this morning, it's Balrampur Chini. Now the stock has been an underperformer in the sugar rally that we saw on Monday, but however, stock has been steadily inching higher. Trading volumes in the stock have risen sharply. We saw a big spurt in the last couple of trading sessions. In fact, the stock is trading at close to a 10-month high at this point in time. Now the big trigger for the sugar sector in general is that the government has lowered the GST on ethanol from 18% to 5%, and there are also news reports that the government may be considering increasing export quota from the current about close to 2 lakh tons per annum. Now in the case of Balrampur Chini, the first half performance was not all that well. In fact, the company reported a net loss during the second quarter of this year. The main reason being the lack of availability of cane sugar. But now that may not be a big problem in the current half, according to Moneycontrol Pro, and they see the company crushing about 10.2 to 10.5 quintals in this crushing season, that's to 2022-23, and that represents an increase of close to about 18% year on year. Besides that, the company has also commissioned one of its distilleries at Balrampur, which leads to an increase of close to about 170 kiloliters per day. And so with that, the overall distillery capacity of Balrampur Chini has risen to close to about 1050 kiloliters per day. Now, ethanol is a big source of revenue for all sugar companies, including Balrampur Chini. Balrampur Chini is planning to sell about 230 million liters of ethanol this year. That's the target for FY23, and close to about 350 million liters for FY24. Well, and that's all that we have in this edition of Opening Bell. Thank you for watching, and we'll be back with you at 3 p.m. today.